All right, so you sent over this episode of Real Estate Riches, and it seems like everyone and their cousin is saying real estate is the ticket to wealth these days. But how much of that is hype? Let's dig in and find out.
Well, real estate definitely has its perks for investors. But like any investment, it's not a guaranteed home run.
Right, gotta see past the glitz and glamour. They jump into talking about appreciation and cash flow early on, but what truly sets real estate apart in the investment world?
It's the tangibility.
Mm.
Unlike, say, stocks, you're investing in a physical asset, something concrete. Plus, there's the whole leverage aspect, which most other assets don't offer. You can control a large asset with just a fraction of the cost up front thanks to mortgages.
Okay, so leverage can supercharge your returns, but couldn't it also work against you and magnify losses? I feel like there are some real estate horror stories out there.
Exactly. Leverage is a tool, and like any tool, it can be used effectively or cause more problems if you're not careful. One of the big things lenders look at is your debt-to-income ratio, or DPI. It's essentially how much of your income is already going towards debt. If your DTI is too high, it can be hard to secure a loan or at least one with favorable terms, and that impacts your profitability down the line.
So it's about being strategic, not just getting any loan you can.
Absolutely. And having a rainy day fund specifically for your rental property can be a lifesaver. You never know when an unexpected repair might pop up or if you'll have a vacancy. Being prepared for those scenarios without putting your own finances at risk is crucial.
That's a really good point. Even if rent is considered passive income, it's not completely hands-off. The podcast mentioned a bunch of approaches to real estate buy and hold, house hacking, even wholesaling. It's a lot to process.
It really is.
Yeah.
Each strategy requires a different level of time, money, and risk tolerance. Maybe comparing a couple of those strategies would be helpful to highlight the differences.
Definitely. I'm curious about buy and hold since it seems like the most traditional route. What are the key things investors should know about that approach?
Buy and hold is all about the long game. You're generating rental income while your property hopefully appreciates in value over time. If you're looking for a more passive approach, at least in terms of daily management, it can be a good option.
It's not completely passive though, right? You still have to manage tenants, handle maintenance, basically all the ins and outs of being a landlord.
Exactly. While many investors opt to hire property managers for the day-to-day tasks, that eats into your profits. On the flip side, if you're handy and comfortable with the landlord role, managing the property yourself can be a good way to maximize those returns.
So you have to weigh those management costs, whether they're in time or money, when you're looking at the profitability of the buy and hold approach.
Right, got to factor in those hidden costs. Now, they also talk about house hacking. It sounds kind of cool, but maybe a little too hands-on for some. What's the deal with that strategy?
House hacking's a popular one, especially for new investors. Basically, you buy a multifamily place, could be a duplex, a triplex, even a small apartment building, and you live in one unit while renting out the others.
So you're like a live-in landlord. What are the big wins with that approach? The biggest one, you could be living rent-free or pretty close to it while your property gains value. Imagine using the rent from those other units to cover your mortgage, property taxes, even some of your own living expenses.
That does sound pretty sweet, especially these days with rent being what it is, but I'm guessing it's not always easy street, right? What are the downsides?
Well, you are living right there with your tenants, so there's less privacy than if you're a regular landlord. Plus, you're on call 24/7 if something goes wrong. Leaky faucet at 2 a.m. That's on you.
True, you'd need to be okay with that responsibility, those potential middle-of-the-night calls. Not everyone's cut out for that.
Definitely not. And you've got to be comfortable navigating shared spaces, setting boundaries with your tenants. A solid lease agreement that lays everything out clearly for both sides is key.
Makes sense. So let's say someone's interested in getting started with real estate, but maybe they don't have a ton of money to throw around. What are some practical first steps they could take?
First things first, figure out what you can actually afford. Look into different mortgage options, especially those geared towards first-time homebuyers or multifamily properties. FHA loans, for example, have lower down payment minimums, can be as low as 3.5%, which makes homeownership doable for more people.
Those government-backed loans can be a game changer if you don't have a massive pile of cash saved up for that down payment.
Absolutely. Another option is partnering up with someone to pool your resources and get started. Just make sure you really vet any potential partners and get a clear legal agreement in place beforehand.
The podcast also mentioned REITs, those real estate investment trusts, as a more hands-off way to get into the real estate game. How do those work, and what should people know about the pros and cons?
REITs are basically companies that own and manage income-producing real estate. Instead of buying property directly, you're buying shares of these companies, similar to investing in stocks. It's a way to get exposure to the market without dealing with the hassle of being a landlord.
So a more passive route, which would appeal to some folks, what's the catch?
The trade-off is that while REITs can offer some diversification, they're still subject to market ups and downs, just like any other publicly traded company. And of course, you're not the one calling the shots on those properties.
So it's about finding that balance between control, risk, and how involved you really want to be. The real estate riches people told a story about someone who hit financial independence through house hacking and then reinvesting their rental income. It's easy to hear that and think, I can do that too, but what are your thoughts on that?
It's awesome their friend found success that way.
Hmm.
But you got to remember, every real estate market's different. What works in one place or at one time might not translate somewhere else.
Location, location, location. It's not just a cliche,
Yeah,
right?
exactly. The same property in a hot market will probably gain value way faster than that same property in a market that's flat or declining. Do your due diligence, researching the specific market you're considering, that's crucial.
And timing has to play a role too, right? Someone who invests right before the market takes a nosedive is going to have a way different experience than someone who got in during a boom.
Oh, absolutely. Market cycles are just part of the game in real estate. You're going to see those upswings and downswings. That's why thinking long-term is so important, not panicking if the market dips for a bit. If you've done your homework and you're able to weather those temporary changes, real estate can still be a really solid way to build wealth over time.
So it's about focusing on the things you can control, like picking the right property, understanding the market, and having a sound financial plan in place.
Exactly. And it's important to remember that success in real estate doesn't look the same for everyone. It's about figuring out what success means to you. Are we talking financial freedom, generating enough passive income to retire early, or is it more about diversifying your investment portfolio? The goals you set are going to determine the strategy you choose.
That is such a key point. Don't get caught up in chasing someone else's idea of real estate riches. Figure out what really matters to you and make your plan from there.
Couldn't agree more. Real estate offers so much potential, from the hands-on stuff like house hacking to more passive routes like REITs. The most important thing is to do your research, weigh those risks and rewards, and choose the path that really makes sense for your situation and your goals.
This whole conversation's been so insightful. We went way beyond just the surface level hype and really got into the weeds on real estate investing. What's the biggest takeaway you'd want our listener to walk away with today?
I think the biggest thing to remember is that while real estate can be a great way to build wealth, it's not some get-rich-quick scheme. It takes planning, research, being realistic about the market and your own financial situation. Don't be afraid to ask questions, get advice from people you trust, and most importantly, figure out what success in real estate means to you.
Fantastic advice. So, for our listeners out there who are thinking about taking the leap into real estate, what's the one question they should ask themselves before diving in?
Oh, that's a good one. I'd say the most important question is, why do I want to invest in real estate? And am I really ready for the commitment and the potential risks? Once you've honestly answered that, you can start exploring those options with a lot more confidence.
I love that. Clarity and being honest with yourself are key. Thanks for joining us for this deep dive into the world of real estate investing. Make sure you subscribe for more insightful conversations on topics that matter to you. See you next time.